Living paycheck to paycheck isn't enough. In the long run, what you really want to be doing is building up your wealth so that you can have the financial security and freedom to do what you want, when you want, without being chained to a job. This might sound like a dream, but it's a genuine reality that you can work towards right now. In this video, I'll be breaking down 8 smart investing strategies so that you can start multiplying your wealth right away. You can start implementing these strategies right now, after watching this video. Nobody talks about number 8, which can financially ruin you if you don't keep it in check, so be sure to stick around for that. But I have to remind you that becoming wealthy isn't just about having a lot of cash in the bank. Taking the action needed to become a wealthy person needs to become part of your lifestyle, and that requires a strong mindset. To build up this mindset, I've personally been using this ingenious billionaire brainwave program backed by neuroscientists that rewires your brain so that you become a stronger, more positive person who attracts money and goodness. I've put the link to this program in the description so you can learn more about it. Click on the first link in the description to check it out. Strategy 1. Compound interest. In the investment world, your initial money is like a seed. The returns you earn on your investment are the fruits. When you reinvest those returns, or those seeds, they too start earning returns. It's a beautiful cycle of exponential growth. Albert Einstein called it the 8th wonder of the world, and for good reason. The longer your money stays invested, the more it can grow through the power of compounding. For example, let's say you invest $1,000 at a 5% annual interest rate. After the first year, you'll have $1,050. In the second year, you earn 5%, not just on your initial $1,000, but also on the $50 you earned in the first year. So you end up with $1,102.50. Over time, this compounding effect snowballs and multiplies your initial investment. The key here is patience. The longer you let your money compound, the more substantial its growth potential becomes. So, start early, let it grow, and watch your wealth multiply. Strategy 2. Portfolio diversification. Imagine you're a coach forming a dream team for a championship. Each player has different strengths and specialties. Now, think of your investments as players on your financial team. Portfolio diversification is like making sure you have a well-balanced squad. If you put all your money into a single investment, it's like betting everything on one player. What if that player has a bad day? Your entire team, or portfolio, suffers. Diversifying means spreading your investments across different assets, stocks, bonds, real estate, and maybe some international plays. Each player in your financial team reacts differently to market conditions. For example, let's say you heavily invest in tech stocks, and suddenly the tech market takes a hit. If that's your whole team, you could face huge losses. But if you also have some bonds or real estate in your lineup, they can offset the losses, keeping your overall performance more stable. Remember, it's about balancing risk and reward. Strategy 3. Dollar cost averaging. I like to call this the consistent savings game. Instead of attempting to predict the market's ups and downs, you consistently invest a fixed amount at regular intervals. You're avoiding the stress of catching the stock market at its peak or lowest. For example, let's say you've got $1,000 to invest. With dollar cost averaging, you might decide to invest $100 every month for 10 months. Some months the market might be down, so your $100 buys more shares. Other times it might be up, so you get fewer shares. Over time, this averages out the cost of your investments. It's a disciplined approach that helps you navigate the market's unpredictability without losing sleep over timing. Plus, it's great for new investors who might find the idea of market timing a bit intimidating. Strategy 4. Invest in what you know. Warren Buffett, the investing maestro, swears by this strategy. He puts his money where his understanding is. Think of this like sticking to your favorite dish at a restaurant. If you know the ins and outs of the industry, understand its products, and can predict its potential challenges, you're in a powerful position. Before you invest, ask yourself, do you know this business well? Can you predict its moves and understand its recipe for success? If the answer is a confident yes, you're on the right track. Strategy 5. Real estate. Investing in real estate can offer you a steady income stream through rent, potential tax advantages, and a hedge against the unpredictable winds of traditional stocks and bonds. Let's say you decide to invest in a property. Whether it's a cozy apartment or a house, these tangible assets have the potential to appreciate over time, literally multiplying your wealth. Of course, this requires significant capital, and you'll need to be mindful of factors like location and market conditions. If you don't want to physically own a property, you can check out crowdfunding platforms. These platforms allow you to join forces with other investors, each contributing a share to collectively fund real estate projects. You might not be the sole owner, but you get to share in the riches. And then there are real estate investment trusts that let you invest in companies that, in turn, invest in real estate. You essentially have a share in a multitude of properties without worrying about fixing leaky roofs or dealing with rowdy tenants. Strategy 6. Invest in quality stocks. Quality stocks are shares in well-established companies, the kind you'd confidently recommend to a friend. These companies show a record of strong financial health, consistent earnings, and a history of reliable dividends. I would recommend checking out S&P 500 Dividend Aristocrats as a place to start when it comes to investing in reliable stocks, as these stocks have a proven track record of paying out larger and larger dividends to investors for at least 25 consecutive years. Strategy 8. Guard against inflation. This is the one nobody talks about, and it's dangerous. Inflation is like the silent thief that gradually erodes the purchasing power of your money over time. To guard against it, you need a game plan. Think of inflation as the opposing team's offense, steadily pushing prices higher. To counter this, you want investments that act as your defensive line, holding the line against the rising costs. For example, invest in assets that historically outpace inflation. Stocks, for example, have shown the ability to outrun inflation over the long term. Companies often raise prices in line with inflation, and their shares can appreciate accordingly. Real estate is another generally anti-inflation investment. Properties tend to appreciate, and rental income can rise with inflation, providing a solid defense against the devaluing impact. So, your strategy here is to assemble a team of investments that can withstand the offensive moves of inflation. Before you start implementing what I've talked you through in this video, be sure to do your research. Only invest what you can afford to, and make decisions with your head, not your heart. And never hesitate to reach out for professional advice if you feel like you need it. I hope you found this video helpful. If you did, I'd appreciate if you like and subscribe, and I'll see you again next time.